One of the hardest things about property investing is understanding the numbers. And this is exactly why we have brought on Jordan Jong. So he's going to cover off what are our paths. There are kind of three lanes when it comes to property investing. There's the sidewalk where you do nothing, you sit on the footpath, you just chill out. Then there's the slow lane, which doesn't include leverage. And then there's the fast lane, which uses leverage. What happens if we do nothing? What happens if we do something? But what happens if we go aggressive? So he has an amazing platform. It's called Game Plans, and we go through what happens when you go through shares, what happens when you go through property investing, and what happens when you use a bit more of a strategic strategy, and what do the end results look like. And in this session, we dive deep into the tools, deep into the platform, and what it all looks like. Hey everyone, my name is Joe Tucker, and together with Jeff Miles, we created Oz Property Investors. We have over 72,000 property investors, and each week we interview top property experts and unpack their insights. And tonight is all about Jordan Jong. He is an expert. He's a qualified property investment advisor, and he breaks down property strategy so that we can understand it, so we can talk to the numbers about what this stuff actually means and how we can implement it into our lives. As a part of this, we also have a bit of an interesting giveaway at the end, but jump in, reach out if you have any questions, and let's jump in.
Live. Shit, that was quick. On Oz Property Investor, we bring the big names and have already been cancelled because I swore. How you going, Jordan? What's happening?
I'm very well, guys. I'm pumped for tonight. It's always a pleasure to come on and see you lads.
Yeah.
Never a chore, mate.
You even sort of brush the hair, got the fancy shirt on, just got my jacket. It's cold down here.
Yeah, it's going to be... I jumped in a cold shower before just to get pumped up, ready to go.
Boom.
Yeah, great idea.
Great, mate. Great thinking.
So tonight it is going to be an epic session because everybody sort of is property is the only sort of thing and is property. There's all these sort of property gurus that say that yes, it is the way and all that. I wanted to, and I've had sort of a couple of conversations with friends over the last couple of weeks, and they've simply said, well, yes, interest rates have gone up. And my sort of costs of holding have gone up, insurances and land taxes and all that sort of good, unfortunate stuff that as investors we do. So I wanted to sort of peel back the layers and say, well, is it actually still worth it? Because I think it's important to sort of critically evaluate and sort of look at where it starts to sort of make sense, not where it makes sense, but where it starts to get a little bit easier from a cash flow perspective. So we're going to unpack property versus shares, because everybody talks about that. We're going to talk about the high cash flow versus your high growth sort of thing. And we're going to talk about, well, how does it actually sort of work? Like, what are the ways where it can sort of work quicker and sooner? And then we're just going to talk about all good things property and sort of model the numbers. And we've got our resident sort of number expert cruncher person here, and Joe, and we've got Jordan as well. So it's going to be a great session. How you going anyway, Joe, as well?
Mate, I'm fabulous. I'm ready for this. Jordan is an amazing gent, a qualified property investment advisor, creator of the Game Plans platform, and absolutely crushes number and data and statistics. And I think a lot of people get wound up and get a little bit lost with all of the numbers. And I guess what I like is to visually see it. What happens if we invest in property? What happens if we invest in shares? What do the alternative paths look like? Because you've got three options, really. There's do nothing and hope the world works for you. That's probably not the best track for you. We've got the kind of slow lane, which is not using leverage and not pushing forward. Or you've got the fast lane, where you can go hard and use leverage, invest in assets like property, and you can, well, let's see what the results of that are. That's what I wanted to map out of, like, okay, we're going to invest. What are our options and what do the returns look like? And there might be some surprising answers in that.
We sort of load things up. So yeah, let's well, for those who've not seen Jordan before, we'll do a quick intro. As Joe said, he's a QPI, a qualified property investment advisor, and you work with a lot of buyers agents. Is it over 100 now on your platform, or is it 150? Like, how many you got now?
Yeah, I think it's 160 or something like that. It grows every week, so it's starting to get there.
Every minute, probably, for the sound of it. And you've seen probably more than this now, but last time we sort of spoke, it was 3,000 plus property portfolios. So I mean, that to me is absolutely, that's up there with Jeremy Ian Nazelli, who I saw last night. They did Facebook Live about the budget and that sort of stuff. And it's we've seen all that sort of mapping and what the numbers look like for each investor. You get to really see some trends and some patterns and some clues as to what works versus what might not work as much. So I think that's where you have unique and key insights. So it's going to be a great session.
I think one of the really cool things about, also working with a number of businesses and a number of clients, but also working really personally, like, we work with Joe's clients really personally as well. And one thing that Joe and I have discussed a number of times over the last, 12 months is just the complete change in interest rates. And so for the 24 months ago, everyone could buy a positively geared or neutrally geared property when interest rates are at 2-3% or something like that. And so property was almost a no-brainer. Everyone was like, I've got access to funding. It's not going to cost me anything out of pocket. Why don't I just go buy $1.5 million worth of property till my borrowing capacity allows me to do it? And then, happy days, set and forget the portfolio. And we're in a very different economy right now where interest rates are coming close to around 6.5%. So the cash flow calculations on the same deals we were looking at 24 months ago are completely changed. And we have a number of clients that come through and they're like, oh, like we were talking 24 months ago and we could have this neutrally geared property. I want to go buy that now. And it's like, well, hold on a second. Like now you're paying 6.5% on the interest rate. It's actually going to be costing you 5, 6, 7, 10 grand a year to hold on to. So these are the things that you need to consider and be mindful of. And if we have chance to do that today, we can even do a comparison of like 3% versus 6%. And so for the people who went and bought a portfolio 12 months ago, like what are they actually out of pocket today as well? So there's just lots of things that we can do with the mapping and the changing. And that's why I love not only working with the businesses, but the clients, because you get to really see what's happening on the ground and really feel how people are impacted by the changes in the economy.
Interesting, mate. I'm all for it. I'm ready to dive on in. We running through. We've got a new sponsored post that is ridiculous.
So should we do hello? I got to copy some copy. So let's do Scotty and we'll pump up to. People have to keep watching for the new ad that's come on for Polizzi. Let's do it, Joe.
There's nothing worse than going into a situation unprepared, especially when that situation is purchasing one of the most expensive assets of your life against a trained property expert in the form of a real estate agent. It's a scary thought, but it is a skill that can be taught. Do you want to learn how to become fully prepared when buying a property so you can get out there, buy your dream home or investment property without the fear of actually messing it up? Scott Agate, the founder and expert property negotiator at Hello House, has been helping people buy their properties by stepping in and negotiating with the agents and saving his clients tens of thousands and in some cases hundreds of thousands of dollars. Scott has now decided to share all that he's learned over the past 28 years in real estate so you can go out there and do the exact same thing on how to find a property, analyze that property, negotiate on that property, and transact on it to get the best results. He's created the Get Buyer Ready course, which is a step-by-step guide on how you too can become an expert property negotiator. It's the easy way of how you can avoid all of these agent games and get the best purchase price on that dream home or your investment property. The course is in short bites for busy people with no fluff at all. Just all the information you need to get buyer ready and secure that next property with confidence at the best price. Scott has been kind enough to give our community a massive discount with the link below. Sign up today before you even think about putting an offer on that next property, and it will be one of the best decisions you ever make.
There you go.
There we go. So, and I've noticed Scotty's been putting out some absolute gold recently, just in some of his posts about negotiation. Like he's been getting a lot of traction on that. So good on him. Before we get into the property versus shares, which I'm sure everybody's tuned into on their Wednesday night, Jordan, I want to sort of ask you. We usually ask people how they got started. We've asked you that probably 8 times already. So first off, I wanted to know, what strategies are you sort of seeing? I wanted to peek beneath the covers. What is working for people? And we'll probably unpack this throughout the show, but I wanted to crystallize and get it all in one before we hit into it. So what's working for people at the moment in their portfolios? What are you seeing goes really well, if that makes sense?
Yeah, I think, coming off the back of what I was just saying beforehand in terms of people 24 months, 3 years ago started to build their portfolio. So they might have got 1 or 2 or 3 investment properties. And at the time, we could borrow about 7.5 times our income. So we had a lot of leverage. Today, it's probably closer to about 5 times our income. So what a lot of people are seeing is they're either getting capped from their borrowing capacity point of view. And even if they aren't capped, properties are now costing them 10 grand a year, 15 grand a year. So from a cash flow point of view, like even if it's pre-tax, there is a lot of hemorrhaging going out. So what we are starting to see is a bit of a shift to more heavier cash flow, either neutral or going really, really deep into something like commercial and being really high yield coming through. And what that kind of does is if we do have, let's say, 3 properties that are costing us 10 grand a year each, portfolio is now costing us 30 grand. If we can potentially offset that with a high yielding asset, such as a commercial property that might be generating 10 grand or generating 20 grand a year, then the portfolio itself is quite neutral. We can continue to build the portfolio because we can use things like lease stock loans, which means you can get a loan on the asset based on the rental income coming through. We can continue to build the portfolio in a tough economic time where lending is a little bit cheaper. Plus, we're then offsetting the cash flows of our portfolio to continue grow and build that and not be hemorrhaging too much out of pocket from our own hand. Obviously, it comes down to every individual, and every individual has their plan. Like I know people who love leverage, and they just like they'll go to a 90% LVR. They don't care if the portfolio is costing them 100 grand a year because they've got strong, really personal, strong incomes. They can, deal with that with the tax man. So their scenario is a little bit different. You got people on the other extreme who will never buy anything that's negatively geared, and they're just always focused on these high yield assets. So everyone is a little bit different but from a general consensus that the people that are either stuck because lending rules have changed or lending's a little bit tighter, or maybe hemorrhaging a bit from cash flow, we're starting to see this transition to at least sort of neutral properties or heavy cash flow, which again is a lot harder when it comes to asset selection in this market because of the interest rate is just so high.
Yeah, and this is what I'm starting to see as well is people doing things like granny flats. Like if I don't have the search results, but I guarantee real estate and domain will get far more searches for the word granny flat potential or existing granny flat. Like I remember, I don't know, about 2 years ago, people were like, don't buy a granny flat because it doesn't grow in capital growth. I was looking at an area that had a property worth about $700,000. $500,000, and the granny flat would have cost about $200,000 to make it $700,000 of value. And that thing went for I think it was $825,000. So the cost of the granny flat well and truly pays for itself. And it then helps with the cash flow. But the only other consideration is there's a lot of competition in this lower end of the market between $400,000 to $600,000. So the investors that can take a step up and go to $650,000, $750,000, you can get some pretty good deals out there for those as well. Don't get me wrong; it's still very, very competitive, but it's not as swamped as the low cash flow yielding assets, high cash flow yielding assets. Apologies.
Now, before we get into, before we get into the old shares versus property, which is everybody, I'm sure, is tuning into, but I want to know, Jordan, what are your thoughts on those people that are insistent on, and Joe as well, like I think this is more like a roundtable, insistent on it has to be cash flow positive, like it needs to be from, and yes, commercial can potentially do that sort of day one, but particularly those in resi, like they're sort of like, then they're going out to these 8%, like even 9%, and like, is that, particularly those starting, are you shooting yourself in the foot somewhat to some extent?
Yeah, I think it really comes down to probably like you growing up and what your whole philosophy around money was growing up. Like if you're in that mindset that it has to be cash flow positive from the start, there might have been some event when you were younger or some condition, or you might have been in debt at some point in time where it's just something that you don't want to be involved with. Like you don't want to be stuck in a situation where you're hemorrhaging cash flow towards the portfolio at any point in time. And if that's your strategy, I think what I've seen really well is people who just focus and laser focus on their strategy. That's the thing that they want to do. That's the thing that they want to execute. And because they do all of their research, due diligence, information, learning around that one thing, they actually do really well from it. So if that's your thing, that's completely fine. But if you do want to potentially build a portfolio, what I've seen work best is have a well-rounded portfolio. So yes, we do have these portfolios that are neutral or cash flow from the start. But if you're buying, as you say, Jeff, in these areas which are, probably not the best from a growth perspective, you're always going to have the cash coming in, but then you might have waves in different seasons where, Melbourne has been stagnant for 5 years. I'm sure at some point in the next decade, it's probably going to catch up to where it should be. And so you miss out on those opportunities in main areas or cities, which may grow at a faster rate or a longer period of time. Again, it all comes down to how risk adverse you are. So if the goal is to never throw in any risk, never be in a cash flow deficit, then continuing to buy cash flow is completely fine. If you're fine to realize that the property might grow less than other properties, it's just that opportunity cost. You're guaranteed, you got the cash coming in, but it might be at an opportunity cost of some potential growth that might be coming through. And if you've weighed up that risk reward scenario and you're much more comfortable just sticking with cash flow, then stick to your thing. That works really well. But if you've weighed up the opportunity and gone, look, I could potentially get into something that's at 8 or 9% growth versus something that's maybe 5% growth, but cash flow neutral. As long as you made that decision, then that's fine. As long as I just love looking at both ends of the spectrum.
Yeah, we're going to do that tonight.
I think it's important to look at both ends, but then really weigh up and do the numbers, because if you are trying to get cash flow positive in an environment with 6.5% interest rates, that means that property needs to be at an 8.5% rate of return, yield, because the interest rate is just the return that the bank's getting. The interest rate is the yield that the bank is getting. So you need to beat that with all the property costs included. So getting cash flow positive in this environment is tough. So the thing is, though, when you run those numbers out in an area that hasn't got a large amount of capital growth coming, you have let's say you buy a $500,000 property and you put down a 10% deposit, that's $50,000. Great. There's no equity that's going to be generated over a quick amount of time or even a midterm amount of time. And you put another 50,000. Okay, great. Now you've got $50 a week coming in, $50 a week. You got $100. You got 2 properties, $100 coming in. But then you've just burned all of you've got your stamp duty, you've got your legals, you've got your deposit. You've just burned all your capital. So we're always trying to balance how much capital we have and our borrowing ability. And then if you buy those properties, you're kind of stuck with them. And nothing is growing. Nothing's growing. Equity's not being created. But yeah, you've got $100 in your bank account. As a 25-year-old, 35-year-old, that doesn't matter. What matters is capital growth. That's really what is making a fundamental difference to people's lives, not $50 here or there.
And I suppose the other. I was going to say the main objection I would sort of have with that as well is, yes, it's all good and well to have that sort of $100 or whatever it is a week. What happens when, and this happens to every property, so it's not whether it's in Mossman or whether it's in Moranbah. I said that wrong. Anyway, mining town. It's you're going to have hot water systems go. You're going to have, eventually you'll have to replace the roof. Eventually you'll have to do a bit of a paint or a carpet and all these things. And all that you might have made, I don't know, 40, 50, 60, 100,000. And then it costs you in maintenance and repairs that amount as well. So if you're not getting capital growth, does the investment stack up? And that's sort of what I wanted to talk about. So should we,
well, it's just right. And that's the beauty. This is literally just going to be based on numbers. It's got nothing else. It's got no emotion involved. It's got no, I prefer commercial. I prefer residential. I prefer shares. It's got none of that. It's just, what are the realistic numbers? And what it's actually going to look like.
Got Royalton in the house. Well, Pete watching. Yeah, get on Pete. I saw you guys last night. So what I was going to say is we'll just put this up straight away. And then I probably don't have to say it every 2 minutes if we do it right at the beginning. So as it says, information is general in nature, does not take into account your personal needs or objectives, not financial advisors. So as I said, you should go and seek your own before. So we're not going to, particularly because we're going to talk about shares. So read that and we should cover it hopefully for the whole session. So I'll do my best not to say it more than once, Joe.
Preferable. Okay, what are we doing? What are we talking to?
Shares plus property.
Well, we're going to paint the picture of the person first, because that's the most important thing. Who are you? What do you have? What are your assets, your resources, your liabilities, your borrowing capacities? Obviously, we're not going to go that deep into it, but that kind of is where it all starts out. It starts with who you are, because the ultimate goal for any property investor is, like the way I say it, is buy the best property in the best location at the best price for the buyer brief. And that buyer brief is the thing that dictates the other three, which is going to be the best price, the best location. Because what I need as an investor is completely different to what Jeff needs, which is completely different to what Jordan needs, which is completely different to you that is out there. So that's what you need to understand first. So Jordan, you're sharing your screen. Do we share that now?
Yeah, you can share it. We'll go through things from start to finish, and then we can start to build out the plan. But you guys can see that all good?
Guess what I'm going to say, Jordan?
I was going to say, to set the scene, because this first sort of property versus shares, we'll do the old, because I was saying we sort of are going to leverage a little bit with shares. I think I was pushing for 60% LVR with a margin loan, but the boys sort of said we should do 40%. I said 60, but we'll do 40% on the leverage.
Can we just start it with the normal of buying shares, because no one leverages to no normal everyday mum and dad investor leverages to buy shares. So let's see what it looks like, and then we can do what it looks like if you do that. But yeah, zoom in a little bit more, Jordan. I just can't see very, very much. Apologies. Who are we dealing with here?
You be the Zoom meister. If it's too small, you let me know. All right. So essentially, we are looking for a goal of 150K passive income, desired retirement age of 62. Person number one has 120K worth of income. They're starting with 140 grand worth of savings at the moment. Does that work for you guys?
Yeah, that's real.
Mm-hmm.
Cool. And then we've got savings of the couple of about 5 grand a month, which I think is pretty good. Let's put in an income for spouse too. We love equality here at Game Plan, so we'll make sure both incomes are the same.
I'm more than happy for my partner and more. That'd be I don't know, no complaints, absolutely no complaints anymore.
Cool. We're going to start with a blank canvas. So not to confuse anything, we're going to start with no properties, no shares, anything else like that. But starting from ground zero, essentially. Now, I did pre-build a scenario, but I think we can build this out one at a time just to keep everyone on par of where we're going to go. So the first thing that we're going to do is build out the share scenario. Yeah.
Yeah. Okay. So yeah, what are the options that we're going to go through?
I think we do 4 things. I think we do shares without leverage. Right. I think we do shares with leverage. Yeah. Then I think we do property at 80% LVR and maybe property at
from Hayden.
A 90% LVR.
Sorry, what are the last two?
Property at 80% LVR and a property at 90% LVR.
Sweet. Yeah. Okay. Can we do 88? Well, yeah, I don't know. Because of the LMI, my sort of OCD, I want to see it at 88. We can do it at 90, but yeah, doesn't matter. Similar.
Cool. Well, we'll start with shares. And what should our initial investment be? Should we just say like 100,000, or are we going to go like the whole 140 grand that we want to put into?
I'm going to say 50K. I want to see it sort of, because I suppose we started with I was assuming people were going to save up, but if you've got it, I don't know. What do you reckon, Joe? Just put it all in.
They have saved up. I mean, if you're looking to invest, you've saved all your money. You realize inflation's at 4, 5, 6%, and it's getting eroded. What do? Do you stick it in a savings account, or do you just say, screw it, let's just invest it all? Like
diversification, though. What about diversification?
Well, what's the diversification going to be? What are they going to diversify?
They could be diversified in multiple shares.
Oh,
yeah. I know. I just think, I like to have, maybe I'm more conservative than what I think I actually am. I like to have a little bit in reserve just in case if the hot water system blows up, or if I've got something.
You haven't got a property. You've got shares. Okay. That's
all
it.
Yeah. That's the landlord's problem. Okay.
That's the landlord's problem.
Let's use 130 because it's a good round number for a deposit for different price points. So we're going to go for a 0 LVR on this. We're just going to go straight cash to shares, so no leverage. And I think Jeff, you mentioned we wanted to see this at like an 8% growth rate or something.
8%.
Let's do 8%. Yep.
Yeah. And are we going to factor any yields to start, like a dividend yield off the shares, or are we just going to say 0?
I reckon you get like a 4% yield. 4% on average. Let's do that. Yeah.
Do you? 4%.
If you're buying a blue chip, like let's just say we're buying like ASX 200. Not saying people should buy that, But you just say you're buying like a top, like you're not buying bloody a speculative mining share. So they do have sort of dividends paid out, and usually you do franking in there as well. So I can throw in a 4%.
Okay.
Cool. Happy with that. So essentially over the 30-year period, our shares growing at 8%. We start off with zero leverage, and this is really cool. So we're spending 130 grand. And this is why I love compounding, especially at high numbers like 8%, is you can really see here.
Just zoom in more than you think you need. Just zoom in before it disappears. Yeah.
Like that?
Yeah. Get rid of that sidebar. Perfect.
Okay. Yeah, so with the compounding, you can kind of see like the first 20 years, it looks like it's kind of straight. Not straight, it does have a bit of a curve, but it's these last 10 years where you really start to see the impact of compounding coming through. And so over a 30-year period, 130K at 8% compounds to about 1.3 million. So not bad. It's a 10x return on your initial investment, but it is over a 30-year time horizon. So it is a fair bit of time between it.
Yeah. And then, okay, so what happens when we start putting our $5,000 every single month into shares? Because that's what we're doing. We're share investors, baby. We're going hard. We're going to make it happen. We're going to, every single $5,000 that we get, we're going to put it in their share portfolio.
We're going to keep recycling.
I think it's an interesting point as well. Shares aren't linear. Like I made 4K this week and lost 3K last week. I think that's the same with property. We just don't actually know that it's going up and down. Like we don't realize that it's not, oh, you get 8% this year, 8% next year. It doesn't really, property, most growth assets don't work that way. Like 1 year you might get, like we've seen in Perth, some sort of areas are getting 25 to 35%. So that's a good point. Yeah. I just wanted to bring that up.
I mean, the whole point of modeling, I guess, is we've got to have like an average point, right? So
no, that's a good point. I agree.
Yeah, if the average is 8%, then you're using that over the years. Some years you're going to be good, some years are going to be bad. What can you do?
Yeah.
Joe, because we don't usually do shares on the platform, we don't have the ability to reinvest that $5,000 back into shares every single month. So I'm just thinking about probably the best way to do this is we could probably every year for the next 5 years, maybe put in a little bit more into the share portfolio.
So what's 5 times? So that's 60 grand a year, right?
Yeah.
5 grand a year is 60 grand a year. So maybe let's just do 120 every second year.
Yeah. Okay, cool. Let's do that. So we're going to 2026.
$8 cost averaging even as well.
Yeah. And this is buying, mixture of shares, whatever you want, different things. They're all, some are going to be amazing contenders. Others are going to do very poorly, and an average return. What is it going to look like?
That's a bit too much.
That's $1 million. Someone got me.
Should we do it?
Sorry, go on.
No, you go.
Well, I guess the thing for me with shares, and obviously you get someone that's pro shares is gonna have all of their reasons why. But let's just pretend you're the best investor in the world. If you don't have a large capital base to work off, it's going to take a long time for this compounding effect to come into play, right? Like, let's just pretend you have $100,000 and you're Warren Buffett, right? You can do 18%, 20% returns. The next year, you've got, what's that, 120,000? Like in a year's time, that's incredible results. But no one can do 20% return year on year. So let's say you get 5% the next year and 3% and then 12%, like average it out. It's still not very much because your capital base, the amount of money that is invested, is not that large. The nut is not big enough to really have a large difference. However, if you're saving $5,000 a week and popping it into shares, I reckon this is going to be pretty interesting.
I think you got 1.2 again, Jordan. Just looking at those numbers up. Yeah, that's 1.2, man.
Yeah.
It's nice that it'd be to invest that much.
So where are we at now? How many years have we invested?
I think this is 4 years now. Let's just say that we're going to invest over the first 10 years or something like that. Like we got a 10-year investment.
Because after, I reckon that's enough. We can get enough of a point to show. I think
Yeah,
Just
anyone,
about
anyone that's watching, throw any kind of comments or questions or things that you want to see out of a share portfolio. I do not invest in shares. I bought a bunch of shares during COVID when they dropped and did incredibly well out of it. So I quit while I was ahead. I sold them and was like, great, I'm an expert share investor and I'll take my 30% returns. So I'm haven't gone back. But anyone that is in the share market, like, what do you want to see? How do you
have you seen? Yeah. Did you see what happened with Wall Street bets again, Joe? Like bloody GameStop, mate. They're pumping, dumping it again.
Pumping GameStop again?
Really?
Yeah, yeah, it's just ridiculous. I don't know why they're doing it, but I don't know, people just maybe have too much time on their hands.
Too much money on their hands. Okay, so we've gone pretty heavy. Like, that's a lot. How much initial capital have we got? There, we got 130, 120 times by 5, is it?
Yeah, and then 130 on top.
So
that's some pretty good passive income you've generated from that.
That's $730,000. So you've invested $730,000 over. So that's a big salary.
Saving $5,000 a month after the fact. It's not terrible.
Yeah, it's good. Okay.
But what we can see, the cool thing that we can see now is that, like, through that time of investing, obviously your initial 130 is growing at the time you're investing as you're starting to go along. But after you finish that investing window of 10 years in 2034, market value is still around the $1.1 million mark. And then we really do have that compounding come into play where the total portfolio value gets to around 5.2 million. So, you know, those first 10 years of investing really does start to play out with you for the compounding. And I think I've seen this on maybe a super ad or something like that or somewhere, but essentially it is like the first 10 years that really does matter. Like, if you continue to add 120K here, it doesn't have a massive impact because it's really that initial amount that's starting to compound that really helps grow the wealth long term.
Yeah, dividends are taxable. So is rent, apparently. Rents from properties. Like, there's no escaping tax, unfortunately, Jay. I mean, not saying there isn't any way to not escape it, but if you speak to your accountant, you can minimize, not evade it. We don't evade tax here on Oz Property Investors. We minimize it. Yeah, it's interesting just sort of seeing how that plays out. Let's kind of, should we? I think I want to sort of make sure we get to the rural versus the capital growth and just interest rates. Is tax deductible start to win for property? I mean, I love property. We run a property group. I just wanted to sort of actually play out a scenario where maybe there's some hope for share investing. I don't know.
Yeah, well, I mean, what's the answer? So what have we got here? We've got $5 million, but what now? We've got $5 million and outcome. What does that mean from a cash flow perspective? Like, how do you convert that into cash?
Well, if we were operating at a 4% dividend, you know, we are getting like 45 grand worth of dividends coming out of the portfolio, which is quite good. Actually, that might be including the debt repayments. Let me check out that more information.
And I suppose the other thing is to build up enough of a nest egg, sort of stockpile that in the end start to see. It's the 4% rule, right? Which has been debunked a little bit, but it's like you build up enough of a thing that you sort of say, okay, you take out 4% and it just doesn't deplete. So once you get to sort of 3 or 4 million, if you take out 4% of 3 million, that's 120K. And if you're making sort of 5 or 6%, you're not depleting that capital. So you're taking out. Yeah, that's how it's sort of, so it's about building up the compounding returns, all that sort of stuff. That's, I suppose, the concept of how it can work. I mean, it's you're right, Joe, 100%. I do agree. Like, I just like to take a bit of a devil's advocate and think a little bit differently. So what do we're not going to do the leverage one because we could do that, but I love talking property. So what does it look like if you're doing property, Jordan, over, so let's just say you buy at 80, let's do 88%. And let's sort of buy 2 or 3 properties over the space of, we did 30 years there. Is that sort of reasonable, you reckon?
Well, it was a 10-year buying window, so we probably can stick to the same buying window. We'll keep it at an 80% LVR, but we will include the LMI on all purchases moving forward. So that'll take us to the 88. And then yeah, we can continue to invest. And I think that the best thing, or start to invest, I think the best thing about property is the leveraging piece of it. So that same 130K used as a 20% deposit or less can get us into a 500K property. So instead of just buying 130 grand worth of shares, we could buy, let's have a look at sort of 550K property. We'll call it resi. We'll go interest only. We'll use an 85% LVR, plus you've got the LMI on top, which is generally about 3%. And then I think, Jeff, we said that we're going to cap the compound growth at 6. Yep. And then do we want to use the same sort of yield, like a 4% rental yield, just to keep it
Let's
even
throw in
Steven?
a 5%. We do a 5%.
We can definitely
feeling ambitious on the yield.
And then obviously with leverage, the downside is we do have the interest repayments. So we'll keep this at sort of 6.5%.
So the question is, Jordan, how much has property grown over the past decade or 30 years, like on average?
Yeah, so on average over the last 30 years, property's actually grown at about 6.5%, and that's across houses and units. So obviously within that range, you've got units that have completely underperformed. I think the last White live we did, Jeff, or 2 lives ago, actually, I showed a unit that hadn't grown, and that was actually negative over 2 decades. So like you're going to have those types of properties within that database, but you're also going to have properties that have grown consistently at 10, 11, 12% over that time. So, property individual assets do perform differently, but on an average basis, we're at about 6.5%.
Okay. So we're not unreasonable here by saying 6%. And the other thing to mention for people as well is that property is not a linear, exactly like shares. It's not linear. It's not 6.5 going forward, right? Over the past 4 years, we've had a lot of growth. That is definitely going to come down. We're not going to see 30% growth. It can't keep up the pace. Don't get me wrong. There's going to be some growth in the right areas. But just let's run a worst case scenario of what happens if it is 5%, or what happens if it is 6%? What does it actually look like? Because there are going to be years of slower. Like, don't expect 20 or 30% returns. It's going to be that they're mental. But don't get me wrong, you can still choose good areas.
Yeah. I think we're going to get more into sort of segmented markets where you will see, rather than seeing everywhere grow sort of that 10 to 15% over a couple per year over a couple of years, you'll start to see areas and pockets that'll grow at that sort of level, like we sort of saw more in the 2010s sort of period. That's what I suspect will happen.
Yeah, it's definitely going to be a lot more. Well, right now it is areas that are growing and areas that are just stagnant. It's very much, you used to just be able to throw data at a map of Australia and be able to get capital growth. And a lot of people have done well there using that strategy, but it's not the right strategy going forward. You're going to have to be a lot more data focused, a lot more strategic in what you're going for, and making sure that your strategy is right as well from the outset. Like, what is actually suitable? What is actually suitable for you? Because I have these conversations daily where people are trying to work out, like, what is the best use for me? Is it to go with residential? Is it to go with commercial? Like, how does it all kind of work? And that's why I love this is, okay, so one thing I've just noticed here, Jordan, is we're starting to hit our borrowing capacity wall. So
exactly right. So I've done a purchase every year, every 2 years up into 2032. So we're not like with the shares, we're able to just reinvest our savings. So, no sort of risk there. We're getting back into it. But when we do hit this final purchase in 2032, we actually start to hit our borrowing capacity wall. And this is where 99% of investors do get stuck on their first couple rounds of buying property, is we are above our borrowing capacity, which essentially means the big major 4 banks will no longer allow us to just get funds as easily as we had in the past. And we might have to start to move to 2nd or 3rd tier lenders to able to continue get lending, or move into potentially other entities if we're working with an accountant and a mortgage broker that can set it up in the right way, or potentially move into, as I mentioned before, those commercial properties that allow us to continue investing. So it's not as simple as shares where you can just keep dollar cost averaging, putting your money back in and growing it that way. But there are other strategies and other methods we now have to shift into to continue building out our typical residential portfolio.
Which we'll actually talk to some of those once we get to Because does game plans just factor in expenses on an investment property? Like what is it? Does it
Yeah, I was
factor?
going to say, let's run through some of the assumptions that we've got here to fully understand
Yeah.
what we're actually talking
Inflation at 2.5%. That's pretty reasonable. I mean, yes, it was running at 8% for a couple of months there, and sort of is now settled around the 3.5%. I mean, that's a CPI. That's the Consumer Price Index. A lot of people argue that that's a load of garbage, so to speak. I mean, if you look at true-flation, there's probably a touch higher, but let's assume this is CPI. CPI I'm good with CPI.
Yeah, I mean, we can increase that as well. So I've just increased that to 3.5%. We can sort of see what all the numbers look like. But at a high level, we've got borrowing capacity at 6 times income. We're putting some savings into offset, which is going to reduce our interest payable. We're going to refinance every time we do a purchase, so extract equity and use that. Inflation, we just talked about. We've got an occupancy rate of 92%. So this essentially means we're going to allow for 4 weeks every year where we don't have a tenant paying rent. And that's doesn't happen every year. Like sometimes you get a great tenant in there for 10 years, but sometimes we do have tenants that shift hands all the time. So we want to be careful with that. We got our rental increases at 5%, which is below the historical average. Average rental yield of 4%, but I think we've put in 5% for all these properties. Acquisition costs at 6%. So that's going to cover our stamp duty, building and pest, conveyancing, everything else like that. We are paying LMI on these properties. And then we've got some other assumptions here that really starts to get into the weeds. But I think from like a property side of things, we've covered most of what we need to there. We've got wage growth at 2.5%, selling costs at 3%. Not that we're going to sell, but yeah. Sorry, what were you going to say there, Jeff?
Where are the expenses in there? Sorry, did you run through these?
So we've got holding costs. We assume holding costs at 1.5% of the asset value, and then they increase with CPI from there. So a good example of that is if we look at our worst year from a cash flow perspective here in 2032, we've essentially got 152K coming in from the rental income, but our mortgage repayments are 177. And then we've got running costs of 42,000. So that is all of their running costs factored in. It is generally quite high. 1.5% is quite high. But that'll cover like, strata, council fees, water fees, like all these maintenance, all these things that we have as outgoings on the portfolio.
So do I understand that correctly? Is that $72,000 negative kind of cash flow or yeah?
Correct. Yep. And the biggest impactor of that is obviously the mortgage repayments. And this is what we were saying at the start of today's session is, we can see as we continue to build the portfolio, our cash flow gets worse and worse and worse. With 1 property, we're at -10. 2 is -23. 3 is -40. 4 is -50. And this is what I'm saying is we start to build a portfolio, even if we're at yields at 5%, if we've got an interest rate at 6.5% and then we're paying holding costs at 1.5% on top of that, as Joe said before, really we need to be starting to target yields of 8% to cover all of our costs, all of our outgoings from the portfolio. And so to have a well-balanced, established portfolio, we just can't keep buying these things because like if anyone is hemorrhaging 50 grand a year towards their residential portfolio, there comes a line in the sand where it just isn't viable anymore.
Yeah, that's one of the things that people don't think about as well is the reason why we're going negative is because we're hoping that the capital growth is growing more than the negative cash flow. Otherwise, it doesn't make sense to invest.
The good news.
And that's kind of why I wanted to have this session because like you look at that, you're thinking like, wow, like 50K, like if you're let's just say you're earning 200K before tax as a household, that's probably, I don't know, after tax, you're probably on about 140, 150. And so you're spending sort of a third of your, and that's fine. And it's just, well, how do you want to run your life? And you've got 100, which is probably okay for somebody on 200, but if you're only on 100 or 120, I don't think you could do that. I think you'd probably just end up bankrupt not bankrupt, you'd end up sacrificing a lot of things.
Yeah, well, we can actually break this down as well in terms of their monthly savings. So I think before we were saying that they were saving 5 grand a month on average. And if we have a look over time as our savings come down, we go from saving 5 grand a month, and every purchase we can see our monthly savings comes down, and it comes down to 2 grand. So, that's a difference of 3 grand a month. We're now contributing to this investment portfolio that like we're forced to pay in. And if we're not careful, if interest rates were to continue increasing, for an example, there's a fine line there. Like if they increase another 2%, we would be going in the negative month on month. And the only way we'd be able to pay for our portfolio is either increase our income and our savings portion somehow, or potentially sell one of the assets to then not have as bad negative cash flow and continue to play it from there. So this is why we do all those future forecastings to go, okay, if we build this portfolio, worst case scenario, are we still comfortable in this situation? But as Joe mentioned, the real benefit is like, well, yes, in 2032, we're not saving as much, but then because of the passive income coming in, by 2037, we're back to where we were. And then over the long term, in 2045, we're actually saving 24 grand a month. And that's purely, well, it's factoring income as well, but predominantly coming through the passive income from the portfolio. Like, as you can see there, there's 20 grand coming in from the portfolio, which is ultimately what we want to build.
So it looks like at about, what is it, about 2037 approximately, it starts to get a little bit, not easier, but you sort of start to see, okay, cool, we're now in 12 to 13, what's that, 14 years away, roughly. 13 to 14 years is where it starts to, that's if you're buying sort of 4 properties. We bought 4 properties in this portfolio.
I think there's 5, yeah.
Okay, yeah.
So what does that look like from a cash flow perspective?
So from an overall cash flow perspective, we saw that the worst year there was negative 72,000, and that's pre-tax. And then we end up going neutral by 2041. So we've got 216K worth of rental income coming in. We've still got 150 going out from mortgage repayments, and then 60 grand worth of running costs. So our rental income is covering all of our expenses, which is great. And then over the 30 years, as we start to build out the portfolio and continue to offset our debts, in 2053, we've got 340K coming in, mortgage repayments of 40, means we're offsetting most of our repayments. We could probably pay off the debts completely if we wanted to, but we still do have running costs of around 85 grand. So all in all, our net position after that is around 220 grand worth of passive income coming through.
Yeah.
Right. Okay, cool. So that's becoming quite, like, that's a lot of, many years of pain on there, isn't there? Like, there's a few good years of tough times. But I guess the challenge is when we're running, well, what happens if we change the interest rate? Actually, what happens if can we use a more realistic scenario of people? Because 5 grand is a lot of savings. Like, most people aren't saving 5 grand. People that run a normal everyday job, surely not. Like, maybe 3. Do you want to run a scenario of 3 grand?
I was saving sort of 3 or 4 grand a month. I mean, it depends on, like, if you're earning 12 grand a month, surely you can live on 7.
12.
Like, can you live on 7 grand? Right. Yeah. Like, not a single person. This is a double income family.
Yeah.
So I do agree with you though, Joe. If you're sending your kids to private school, you're probably not saving 5 grand a month. So depends on what your priorities are, I suppose.
Yeah, so at 3 grand on that final purchase, we actually go completely negative from a cash flow position. So a negative around $300 a month, and we're only just positive the year after doing a little bit more offsetting and our rents increasing. And then we don't get back to that 3 grand level until 2040. So you're spot on, Joe. It's essentially 16 years of hard yakka and being quite risky with not enough cash coming through to be able to underpin this portfolio so that we do have those larger returns over 20 or 30 years.
Yeah, this is feeling a little sad. Like, well, I don't like the idea that this is doing to my. It's killing my vibe. I'm not vibing.
Well,
with this.
over the past 20 years, if we average it out, the interest rate is 2.5%, right? So right now we're that's the cash rate, right? So there'll be buffers on top of that. So what would that be? 4.5, 5? 5%?
Yeah, 4.5. 4.5.
So what does that look like?
Yeah, awesome. Let's go and
because this is one thing that I struggle with when it comes to compounding interest and looking at things that are so far in advance is there's so many variables. Like if we ran this scenario, let's say 5 years ago, right? You probably when you were, this was on a spreadsheet, we would have run this same scenario at 5% interest and 5% capital growth. But we've just had 3 years of 20-30% capital growth. So what does that do for your portfolio? Well, it brings the capital growth forward, and then means that you can do whatever you want. Like you've got that extra equity there to be able to bring your portfolio forward, which is what I find most interesting. One of the questions here is, should $500,000 property acquisitions still exist in the second and third acquisitions on the way that the property market is moving? So maybe we do these. Oh, have you already done them at the other value? Yeah, future value.
I did one of them, but yeah, essentially a 550K property in 2032, if we get the future value of that, will be closer to around 870 grand. So realistically, if we're buying exactly the same quality property that we would today, but in 2032, it's going to cost us 877 grand. I just did 550 to keep them all relative so that we know what we're looking at. But yeah, it's probably going to be pretty hard to find a 550K property in 2032.
Yeah, probably not worth buying it.
Exactly. But if we just run the numbers at that sort of 4.5% interest rate, and this is why I really like to do the comparisons at the higher interest rate. So we know that like if interest rates were to continue at 6.5%, are we able to continue to survive? And the question was no. Like we actually go negative from a monthly cash flow position. And so the decision to buy that fifth property might not be as bad. But we can see now, if we go at a 4.5% interest rate, we're still staying around that 3% number the entire way through. And worst case scenario, we get to 2.5 grand a month. And so we're very comfortable, considering we're at 3 grand now, based on the yield at 5%, that we're only having to fork out a little bit towards the portfolio rather than, hemorrhaging essentially all of our monthly savings. And from a cash flow perspective, worst case, we're negative 75 grand. And in 2032, we're negative 24 grand. So, not as terrible as it was looking beforehand. And that's a huge difference. It's a difference of 50 grand. And, we're only changing interest rates by 2%. And so this is why I love to just make sure worst case scenario, are we going to be comfortable? If not, let's not make the decision. But these things can change.
Yeah. Okay. So let's paint the picture. What is this ultimately? What's the goal age? We got the goal age there of 62. So is this at your age? So
yeah, this is I think 30. So
30.
Yeah.
So 30. Yeah, 30
essentially.
So 30 years from now, at the age of 62, this is what the size cash flow you would have. So you've got 340, and that's buying what, 5 properties?
Yeah.
5 properties, rental income 347,000, repayments, and then running costs. So total net income is $208,000 cash flow positive in the bank.
Yep, in the bank coming in, and that is pre-tax though, so you do have to pay tax on that as well. But I think ultimately, and what we really haven't talked about from a property perspective, is the market value, right, and the equity position within the portfolio. Yeah. So, if we have a look here, after the acquisition window, our portfolio would be worth around 3.6 million. And then if we allow that to compound at 6% year on year, we're now getting to around $13 million. Now we're still carrying a fair bit of that debt that we accumulated along the process. We still do have debt of 2.9 million because we've just been on interest only, but we do have savings of about 990K. So we could essentially clear out, we'd be left with about $2 million worth of debt, which means we do have a total equity of around 11 million in combination with what's left in the portfolio and the savings. And I think realistically, we go through those really hard first 10 to 15 years of making those repayments to build the portfolio to have this $10, $11 million equity position outcome after that time horizon.
I'm just going to, so Ella asks, hi team, may I know which websites? This is Game Plan. So it's a B2B type platform still, is it, Jordan? Like you haven't opened it up to the general public?
You can go in there, gameplans.com.au, check it out, see what it's all about. But yeah, predominantly we work through B2B, and Joe offers it through his services as well. So you may as well just go through and inquire through there.
Yeah. What I want to say, so we did promise, we'd talk about rural versus capital growth types properties, and we promised solutions as well. Like this is all feeling a bit, yes, we're getting a lot of equity, but if I'm so heavily deep, if I'm knee deep in sort of debt, how does that make me, how am I sustaining that? Like, and particularly if, yes, rates could go down to, a cash rate could go to 3%, but what if it stays at 4.35? What if it goes to 5% cash rate? And then our interest rate, I mean, don't change it, Jordan, but I'm just saying, like, we don't know what the future holds. We can never predict that. And I like to sort of plan for the worst and expect the best. So that's kind of why I wanted to. It's great we've got equity, but let's throw to another scenario. Can we quickly change the tracks and look at what happens if you get a 9% yielding property and it's growing at 2 or 3% versus one that's kind of almost the inverse of that.
Let's be more real. Let's not do a 9% yield.
Well, you can get them though. Like you're just buying, like you're buying in.
So we're running. Are we talking commercial or
no? I mean it's resi, but you're buying like you're talking sort of thousand population towns, because we get a lot of questions on the forum about that. People are like, oh, what are your thoughts on buying in Roma or Miles or places like that, like sort of really sort of outback Queensland or outback New South Wales, where the yield is gross yield of 9%, but on a 200k purchase, you're making 18k per year, which I mean is great. You're making 18k without any expenses. So after you might put $3,000 in your back pocket, and that's assuming that the property's rented the whole time. So that's why I sort of wanted to run that scenario and sort of see what it looked like.
Yeah. Are we going to do same purchase price?
Nah, you wouldn't. I mean, if you did a 500k purchase price and 9% yield, that's a. So yeah, probably throw in a.
Well, that's what you do when you buy two, right? Like if you buy two at 200,000, like that's $500,000 in.
Yeah,
true.
Okay.
Costs, but costs on here are based on percentage, so it would net out at the same.
80% LVR.
The growth at 3%. That's
residential. Your growth at 2.
20% deposit.
Yeah, you'd need to put in a 20% deposit, I'd argue. A lot of these.
Yeah, the banks wouldn't let you. It'd be too high risk.
Cool. Awesome. So we can add that into the one portfolio. And so with that, market value goes from 500 to 1.2 over 30 years. So at 3%, we're really getting impacted. But from a cash flow perspective, we are cash flow positive from day one. We've got 41 grand coming in, 22 on the mortgage repayments, and then running costs of 7.5. So we're positive 11 grand from day one. And then just that property itself over 30 years starts to generate about 110k worth of passive income without any mortgage repayments and just running off the running costs on that particular asset. So this could be that sort of
if you flicked it over to principal and interest, what does that what does that do to what does that look like?
Yeah.
Eventually at some stage.
What are your thoughts on principal and interest only, Jordan?
Yeah, so from my perspective, I guess like generally my approach for my personal portfolio is to just stay on interest only. And the reason I say that is I use something called an offset account, which is essentially just a separate account in your banking app, which is linked to your loan. And I use that as like my daily transactional account. So instead of me being forced to make a principal repayment into my loan, which I have to make, I'm forced to make that, and then I can't take it out again. I don't have access to those funds. What I would rather opt to do is take that principal portion, put it into my offset account. It means that I'm not forced to make the principal repayment, which means my overall cash flow is much higher on the portfolio. And I've got access to those funds if I need them tomorrow. So say I wanted to, Joe finds a really good deal. I want to take action on it right now. And instead of if I had, say, like 130 grand in my my principal in my loan, I couldn't just extract that. Whereas if I had 130 grand in my offset account, I could take that out, use it as a deposit, and use it really quickly tomorrow. So my preference is to go interest only with an offset account because it's essentially the same thing. You've just got access to the funds that are in there. The only reason you wouldn't want to do that is if you're not happy with the opportunity cost of doing so. So generally, an interest only loan would be about 0.5 percentage point higher than a principal interest loan. So you might get an principal interest loan today at 6%, where interest only might be at something like 6.5%. So you are paying a higher interest rate to do so, but you do have more flexibility and access to funds, and you've got more cash flow coming in from the portfolio.
You have to be disciplined as well. Is the only, like, I think a lot of people are just not that great with money because it's just the way it's sort of presented. Like presenting it this way, like I think if money was taught like this at school, which it should be, I think there'd be a lot more people sort of financially savvy and maybe even financially free. Maybe a controversial hot take there, but there's probably a reason. We'll go to a conversation over at a bar, a few beers or a couple of wines or daiquiris, whatever you want to drink these days.
Yeah, so if we move it to principal interest, we're still positive, but only by about 5 grand. So again, if you have a look at the difference, but before we were 11, now we're 5. So that's 6 grand of difference of cash flow that if you were to go on principal and interest, you're forced to repay. You have to make that repayment. Whereas if you just go interest only, that's the 6 grand that you now have flexibility around. You can put into the offset account. And if you can manage money really well, then you leave it in there. But that's the cost as well. You might go and use it.
Interesting. I've got a question that's come up from Blake McNally. Great name. This is the first time I've seen this. You tagged us. What is your net return on property investment over the last 10 years? Which is a very big question. Very big question to answer.
He sounds a bit angry, and then he's like, "Oh, okay. Well, I'm curious now. You got me. Like, okay. What? Let's talk turkey." Yeah.
Exactly. So I'm just going through some data and stats, just looking at random suburbs. There's a suburb in called Birkdale in Queensland. Over the past 10 years, that grew 105%, which is 10.5% over the past decade. Over the past decade, interest rates were at very low, and then they're now medium high. So let's just average that out to be at what, 3% interest rates. So would that be a cash flow? That would be a cash flow positive deal. So let's just say we had a really good run with negative, like where we were making money on our Birkdale deal. But it's pretty easy to run those numbers, right? You buy a $500,000 property in Birkdale, it's now $500,000 times 10.5%.
Well, it's an interesting way of asking, because I'm just thinking that is that referring to cash, or I think that's what it's referring to. It's referring to like a net yield, like net return on investment, net ROI in property, or are we talking capital growth? Like which part of the equation are we talking about? Because one is a cash and one is a more a capital return. That's what I want to sort of unpack.
It would be like, I mean, yeah, I guess it's if it's at 100%, then you've just doubled your money, right? You've got a 500,000. So, but also it's not actually. There's a very good point. There's a very good point to raise is that it's not 100% return on your capital invested. So if you let's just say back in the day, you bought a property with $100,000, you paid stamp duties, deposits, legals, everything. You put $100,000 into this asset, and in 10 years' time, that asset has grown $1 million. Like it's right there in the data, 105%. So it's gone from $500,000, it's doubled. That is now $1 million. It's not $100,000. It's not, 100%. It's 100% on your return. So that's times, like, that is a far better return that shares will ever get you because you've leveraged the money. So I think that, I don't know. Is there a better way to say that? Can you say that better than me, Jordan? I feel like you can. I feel like you can very clearly articulate what the hell I was just trying to say. But
yeah, essentially it just comes down to leverage, right? So with shares, you're 100 grand in and you get a 9% return. With property, you're 100 grand in, but you get a 500K asset. And that 500K asset will continue to compound on the 500K, not on the 100K that you invested. And so when we're talking about cash on cash return, if you're only 100 grand in and you're $1 million net return, you got, let's say you're interest only, you got to pay the 400K back. But after you've paid the 400K, you're left with 600K. So you put 100K in, get 600K back at the end. You know, cash on cash return is a 6 times multiple.
600%.
So, yeah.
So
You can leverage. I know you said you don't leverage shares.
That's a 500% return on your money. 500. You've gone from $100,000 to $600,000 in 10 years. That's 500,000. So the market has moved up 100%, but your return on capital, if it's cash flow negative, cash flow neutral, is 500% return.
And look, that's a very high level numbers. Like you've got your purchasing costs, stamp duty, building and pest conveyancing that you got to factor in, plus your selling costs, which is your agent selling fees, capital gains tax, and everything else like that. But holistically, if you're just looking at the numbers on cash return, that's how you would calculate it. And yeah, that's why I love property, because you can leverage into it.
Great question.
Leverage does cut both ways, though. I always like to sort of look at, okay, it's great, it goes up or can go up. What happens if you bought in Gladstone in 2012 or 2013, which maybe that's not the place you should have been buying back then. But if you did, you're sort of starting to just get back to, depending on what you bought in Gladstone. But yeah, just a sort of caution that it can really be fantastic. But yeah, just be a little, don't go out and buy whatever you see. Like be a little bit more discerning.
That's one thing with every type of investment is the opportunity that potentially can happen. Like even the GFC in the US, properties were falling by 30%, 40% or whatever it might be. And, you know, we all have this philosophy of it's never going to be us, but it can happen. And I think that's one of the things that you just got to be wary of if you're investing in any type of market or any type of asset, is it can potentially happen. And we love to put on our Aussie hats and say it's too big to fail and it's backed by the bank, so it'll never happen. But it has in many economies, in many times and points in history. So I think it's just one thing that we've all got to be wary of.
Yeah.
So should we?
Yeah, I was just going to share my screen real quick, just because on another point to make is like when you look at Australia, like this is a CoreLogic chart pack, right? So the most recent chart pack that's come out of course, I don't know why I can't zoom in. Now I can't zoom in.
Hey,
Zoom master.
Yeah. So over the past, 12 months, Australia's property market has grown 8.7%. Combined regional 6.4, combined capitals 9.4. So the capitals have actually overachieved. So you can see regions there. But that's averaged out at 8.7%. But if you look, you can look at the data even closer. And this is what happens when you zoom out as far as you can go. Australian property has done 8.7, but then you zoom in closer and then zoom in closer, and you can start to see that some markets have performed better than others. Like if we look over the past 12 months, the biggest performer here is 21%. So if you bought a property for $500,000 in Perth, that has now gone up. How much is that? How much is
600,000, Joe?
100,000. $100,000 in 12 months. Brisbane has gone up 16%, 14%. But if you bought in regional Northern Territory for $500,000, you'd be down what's that, 10 grand? Be down 10 grand.
A little bit more than that, 25K.
Good math. Thanks, Jeff. But it's just interesting because I think when I hear this number, 8.7%, I'm like, I don't really care. Everyone's like, oh, don't time the market. It's not about time in the market. It's about time in the market.
It's about both. Why not just both? Why can't we do both? What's that?
Buying in a good location that's growing, but also has long-term sustainability, because you want to be buying in this market 12 months ago. No other market has performed as well as this one, but will it perform?
I want to be buying in Perth when we did that live on Calling Up, Joe. And Rockingham and Secret Harbour.
I think I was.
20. Yeah, I was. Yeah. Anyway, so we're over the hour. We haven't even gotten. I haven't been. I've let you let us run a little bit too much. So I want to so what does it look like from a capital growth? And then we'll run our. I'm going to give you sort of 10 minutes to this, and then we'll do the sponsor, and then I think we'll wrap up with questions. As much as you want to look at solutions, we can quickly run through solutions and do Q&A. How's that sound, boys? Let's do it. So, what does it look like if you're focusing more on capital growth? So, let's be a bit.
Well, the thing is, I feel like we just went on a capital growth spell.
Did we?
I feel like we just did $500,000 that was growing at 5%. Like that was a pretty good return. What would you do, Jordan? What do you see that is working for people? Because this is, again, like I talk about this 8.5, this 8.7% cap. This is kind of what we're talking about here. We're averaging it out and blah, blah, blah. What really makes money is creating value in property. Like if you can find a property that you can add value to, buy a property for 500, like I just did it myself. Actually the vendor hasn't signed it, so it's not 100% done. But we're going to create a Oz property portfolio if Jeff confirms it. But
we're doing it as long as I can buy.
You're doing it. Okay, so Oz Property Investors has bought a new property, and we're going to release the portfolio, and we'll go through all the stats and statistics, how the negotiation went, and all that kind of stuff. Purchase that for $610,000. But I'm going to be doing a value add strategy on that. I'm going to be adding a room to create value in that property, which is going to boost it by $100,000 in year one. So I'm going to buy it for 610. I'm going to spend $20,000 on maybe 30 actually, probably $30,000 on renovating it, and then it's going to be worth $100,000 more, which then gives me equity to be able to then move my portfolio forward. So how do we?
Let's hold that, Joe. Let's hold that thought. I want to tease the audience to come back because we'll sort of otherwise we'll talk for another half an hour. We won't get to the amazing new sort of thing that we've got. So if you want to see strategies that you can actually sort of start to outperform, and Jordan talking, because Jordan's seen this hundreds of times. I imagine maybe thousands.
What's Jordan doing right now? What are we going through? He doesn't know.
We're going to throw to our sponsor, Joe, and then come back, mate, because we're at an hour 10 in. That's what I'm thinking. Our new ad. I'm excited.
Hi all. I've got a big problem. This is the Policey Property weekly sponsorship ad. Except today, I've got nothing to sell. And this is because of you. Due to all your kind words, comments, amazing feedback, and sincere compliments about my newly released commercial property investment course, the Commercial Property Institute, I realised today that due to the Facebook algorithm, many of you, in fact, the majority of you, still may not have heard about this yet. So I'm going to do 3 things that no other course provider would even dare to do. Let's start with number 1. I've taken out 5 lessons of the course and put them in the link that's been dropped into the chat right now. This way you can see the value in the course, you can see the production, and you can see for yourself the depth of the insight that we dive into. Every other course provider hides everything behind a paywall, and you only find out if it's valuable or not when it's too late. Not me, you're going to see 5 sneak peek lessons from the course from which you can make an informed decision about whether this is for you or not. Now, number 2. To further prove to you that this course will transform you from being a total beginner into an elite commercial property investor, I'm going to show you a picture of me before I discovered commercial property investing. And now, after I've discovered commercial property investing. Alright, you finally got your Steve without a beard shot, so it's time to get serious. Let's talk about number 3. And this will leave you without any doubts. Everything I know about commercial property is in this course. Every tool that we use at Policey Property is in the course, and it's delivered in a learn at your own pace online course at $4,997. But you're not going to pay that. In fact, you're not going to pay a cent if you're quick. I've decided to extend the free offer to OzProp Investors Group until the end of June. That's right, no cost, no credit card, lifetime access until the end of June. All you have to do is click the second link here in the chat and it'll take you to the page where people normally pay $4,997 for it. At this page, type in the discount code OZPROP and instantly get the Commercial Property Institute course for free. No catches, no gimmicks, just a limited time only offer. So click the link right now and get your instant access free. Thanks again for the amazing feedback, and I look forward to seeing thousands of commercial property moguls in the near future. Cheers, guys.
Jesus Christ. That
There we
went way
go.
through.
Oh,
Yeah, I
long
feel
ad.
like I need to go and do a Rocky kind of. I'm inspired. Like let's go, like the music and everything. So, okay, we promised sort of ways, and Joe sort of talked about a real life example that we're sort of looking to sort of create that Oz property portfolio. So, what are the
Well,
ways that you're seeing? Sorry,
Well, one of the so I want to Jordan's very good at building these out. I'm gonna run through some real life scenarios because that's what I think is important to see for people. So, can we go back in time, Jordan? Can I buy a property that's grown in equity? So let's just say I'm going to look on my list of property purchases that I have purchased over the past couple of years. Let's go 2020. Let's actually 2019. Here we go. 2019. Don't worry about an address. 2019, I paid $280,000 for it.
What's
And
it
it's
currently worth?
550.
550. Nice. And what did you say that you bought it for?
280. And then I spent $22,000 on a renovation.
Cool. And when did you buy it?
2019.
2019.
Maybe 2018. I don't know. Maybe 2017. I don't know.
What's the current loan on it?
Oh shit. Would have been 10%.
You're gonna
Okay. Just go 260.
put on some hold music. Doop,
Yeah.
doop.
Yeah, sorry. I thought this was a good idea. But it's not. But I think it's better. I think it's exciting to see what is actually possible and what are real numbers, what are real things. So I think it'll
You
be
spent 30,000 on a reno?
yeah, sure.
And what's the rental income?
350. No, 400. 400. No, we just upped it. 400.
Nice.
No, not 4,000. No, 400. Management 8%.
8%.
8%. Yeah, that's
And then like rough expenses, I don't know, might be like
Oh, shit. Yeah, whatever you reckon. How much of it? Well, it's now 550,000. It's now valued at 550. Let's just say rough expenses.
$6,000 a year, including
Yeah.
maintenance.
Are we
Let's go 10.
talking council rates? Are we talking sort of
Yeah,
it's not
everything, all outgoings.
Yeah, all outgoings. Let's go with 8.
Yeah, because you throw insurance in there. What about, is there any
8.5.
land tax?
Yeah,
Probably
8,
land tax.
8.5.
Cool. And I'm guessing, Joe, you want to show the ability to extract equity on that asset?
Well, that's it, right? Like I don't have a big, I don't have a big deposit. I want to pull the equity out, and that's what I did. That's why I renovated. I bought it for $280,000, and I got it revalued at $360,000, and that allowed me to extract equity and then go again.
Yeah. So if the current loan on that was 260, you would have a total equity of 290, and then at an 80% LVR, which essentially just means we're going to refinance this property at the new valuation of 550. We would have a borrowable equity of 180 grand that we could then extract, and we could do a few things with that. We could use 180 grand as a deposit for another purchase. We could use that 180 grand to do like a granny flat on the back, and then have another income stream come off the back of that. It would also increase the value of the property. So you could add the granny flat, increase the rental income, which would overall increase the yield, and then increase the value of the property, extract that equity again, and then recycle that into a potential second purchase on top, where you could do the same strategy, right? So you could do 2 or 3 or 4 purchases, extract the equity, use that to build the granny flats, and then continue building the portfolio that way. And so I think, like, ultimately, to answer your question, Joe, in terms of what I see really works really well, is things like that, is having that equity position or equity potential in the asset, and really understanding the market. So if you know the market and you know that 4-bedroom houses are selling for 600 grand, and you can buy a 3-bedroom for 480, and you know that adding a bedroom to that house is only going to cost you like 6 grand, just by doing that small little renovation, you could potentially open yourself up to a much bigger market and demographic where you might have a higher rental yield, you might have a higher valuation on the property, and you can continue to build it that way.
Love that.
Second way I've seen it is that granny flat potential, particularly in today's market with the higher interest rates coming through. We do want to have multiple sources of income potentially come off the asset if we can. So with that granny flat potential, you could either lease that out as like just a typical normal lease, or I've seen some people really go hard and go for like the Airbnb type strategy. Now, depending on where the asset is, and if it's in like a holiday destination or a location where you might get a lot of Airbnb residents, like you could really start to ramp up the rental income off that secondary dwelling. You may lose a little bit of rent off the first dwelling because there's an attached dwelling on it, and you're going to have people in your backyard every now and then and all that sort of stuff. But you can really ramp up the cash flow from that secondary dwelling coming through. And hopefully between those two dwellings, you could allow yourself to be neutral on that property. So you're not constrained from a cash flow perspective, and then you can continue leveraging that into multiple secondary dwellings.
Yeah, and that's the exact purpose of this property, right? It has the potential to be subdivided and split it off 1 into 2, but it also has the potential for a granny flat. Now, for me at least, I would rather subdivide. But if you haven't got the opportunity to subdivide, granny flat potential is a great way around it as well. Let's go buy another property. We're buying this property. This property was purchased in June 2022. So June 2022, we paid $472,000 for it. So this is a 3-bed, 1-bath property in South Australia. Beautiful little thing in a suburb called Paravista. If anyone knows that lovely area, Paravista, very normal everyday type of property. This
What's
property,
what
is it now? It's valued at $610,000. The rent is $555 a week. I think, yeah, $555 a week. 649 square meters. The ability to split it 1 into 2. Not that we're doing that right now, but it's the ability. So like we were factoring before the growth of 5%, but that's not what this is. This one's grown how much? Purchase 472,000. Now we did do 30 grand rent, 20 grand renovation on this one as well. 610, 1, 2, 3. So that's $138,000, which is 29% return, which is 15% over the past 2 years.
What did you say the rental income was?
550.
And do rough running costs the same, like 9 grand, 10 grand?
9 grand.
Cool. So we can look at property number 2. I'm going to zoom out a little bit here because I think we get some really nice breakup. So yeah, essentially, if you're going from 420 to 610 over 10 years, it's a compound growth. It's a total growth rate of 45%. And a compound growth rate of 20% over the 2 years. We've got a current loan of 420, which means we've got total equity of 190 grand and then borrowable equity of around 70 grand as well. So this is factoring in, I mean, what would the original loan be at 80% LVR? We should do that.
Yeah.
420 at an 80% LVR would have been 336. Cool. So you have done a 20 grand renovation, so we are a little bit more cash in, but now we've got a total equity of around 280 grand and borrowable equity of 150. So 20 grand investment to then be able to extract 150 grand. And then same scenarios, again, we can go and recycle that 150 grand into granny flat, another deposit for another property, and continue to build the portfolio that way.
Okay, so we're going to go for another property. So when can we buy our next property? That's the question. Are we hampered in any way? Like, what's our constraining factor here? Have I got cash? Have I got borrowing ability still? So I'm not near my borrowing ability. I can still borrow. So let's buy something soon. Any recommendation on purchase price that is going to be? Oh, gee, this is a good deal.
Comes out to the individual and how much cash they've got available. But from a borrowing capacity perspective, let's say that we're just going to buy another property. Between the two properties, I think we had like 300K worth of borrowable equity. We can go in and take a look actually. Yeah, so borrowable equity was around 330K. We're not capped from our borrowing capacity. So realistically, we could go up to like $1 million if we really wanted to.
Okay, well, let's not go wild, child. Let's go another purchase. We're going to go a resi purchase. This property was purchased in a suburb called Morpeth Vale in South Australia. This was purchased on November 27th, 2023. So not too long ago. The purchase price was $485, and then $485. Now, this property actually had a subdivision done. So we subdivided and split off the back. What's the best way to?
So 485, and what's the current value?
Well, what's the current value? The problem is it's been split. So we subdivided off it and we sold the front house. We subdivided this block off. We bought it for $485,000, and we did something called a battle axe. So the house at the front, we kept the house at the front. So I'll share not my screen, but my little camera. So this is what it looked like. Oh yeah, you can't see that for donkeys. So this is a battle axe block. It's a 892 square meter block. The house remains on the front, and we subdivided and split off, and we have this piece of land. We then sold this house on the front 8 or 9 months later for $520,000, and then own this block of land, which is worth about $280,000 to $300,000. So maybe we're going a little bit too deep with this one. Let's just keep it as a buy and hold, because we're getting a bit crazy. I don't know. Is this valuable for people? I feel like I might have complicated this a little bit more than I need. Jeff,
I'm just trying to see. Like, I'm like, okay, like, what's the strategy? Like, how do people then sort of, how do you do this again? Is what I'm sort of, trying to think.
I think the whole thing Joe's trying to
the-
demonstrate is like, what can we do to make things work at the moment? And I definitely think some of those strategies that you've implemented are really good. Another strategy that I'm a big fan of is having one really strong growth property that you purchase under a particular entity, and under the same entity buy another really strong cash flow property. So you're serving the purpose of the growth, and then you've got the cash flow property to sustain those two together. So together, when you run the numbers, they should be cash flow neutral, but you're in a really strong compounding growth property as well, which will help you build out the wealth long-term big picture. I've seen that strategy work really well as well.
Yeah. There's a balance, right? There's a balance of cash flow and equity. And the goal is you want to get the most amount of growth you can humanly possible, while also being able to service the loan, service the debt without going too negative. And that what is too negative really comes down to a personal preference. Who are you? How much have you got to spend? What is your expected salary? Because if you buy a portfolio, because that's what you're doing, you're buying property, you're buying a portfolio. If you want to do this, and you want to retire in 5 years, you might find yourself in a bit of strife where you're going to be negative cash flow, and you need to work to be able to afford the portfolio. So freedom isn't free. It's got to get there. Matthew Brand's mind is blown.
That was about the Polizzi ad, because he was excited.
Oh. I thought it was okay. Thought it was the amazing subdivision deal. Soon to be Matty Brand. Soon to be. Okay, so I guess we didn't really get anywhere on this portfolio. We started building it out.
Look, I think you demonstrated some good deals and some equity that you've been able to generate in a short amount of time, and how we could recycle that into future purchases, which I think is good. So
that's the thing. Like you get, like, in property investing, we don't do it for you don't do it for these. You do it to, like, you don't do it to make 20-30%, but you can make 20-30% if you do it, do it smartly, do it correctly. Like, you can really force a whole heap of value. The amount of value that you get is the amount of value that you create. So if you do renovations, if you do subdivisions, if you do developments, you can really push and squeeze the return on return on value. One of my favorite sessions is we only just had it recently with Richard Morgan. I rewatched that back again because I loved it so much, and I went through parts of it today. What he mentioned in there is like, that's what the goal is. It's a return on capital. How much money am I putting in and how much money am I getting out? When it comes to commercial property, when it comes to these cash flow assets, like that guy has absolutely crushed property development and he continues to do so. And I'm like, so in that session, I asked him, so what are your thoughts on commercial? And he's like, look, the reason I'm not doing commercial just yet is because I can, this is paraphrasing and obviously not what he's, word for word. I don't want to quote him. But he said that like, I can convert my portfolio into capital growth whenever. Like I can take this. So why would I choose an asset that is a little less growth focused when I don't have the cash and equity? Like as a new starter, why focus on cash flow and when residential is there for capital growth? It's there to create value so that you can then multiply that capital growth. But if you just focus on cash flow, it doesn't give you the return because it doesn't give you that exponential growth. And it's only when the people that I deal with property investors every single day. People call me all the time saying, Joe, I want to buy an investment property. The people that say, I want a cash flow positive property are the people that have never purchased a property and experienced capital growth. The people that have experience by buying a $500,000 or a $400,000 property, and then turning it into $472,000, and it's now $610,000. They're like, I want another one of them. How do we do that again? Not that I can promise that I can do that, but that's the true value. It's not this cash flow focus, because once you've built that capital growth, you can then convert that at any point in time by selling everything down to a cash flow asset. So I don't know if that helps anyone in any way, but that's kind of the way that I think about it.
Yeah, growth is the way to get out. Cash flow is the way to stay in. So, if you can go for growth the whole way through, then you're going to have a much better financial outcome. But at some point in time, if you need cash flow to be able to sustain and survive, then you could throw in a commercial. But I 100% agree. If you want to be an active investor and have the potential to do developments and are well skilled at it, then that's ultimately the best way to make wealth.
Yeah. Or it's just business, right? Like business is the best return on investment. Like it's like shares are really good, property, and then business, just you can 10x your return. You just need another customer and that'll make a massive difference. So there's many ways that this works, and there's many ways in property investing. So I want to hit some of these comments up because this has been an awesome session. So I hope people have gotten value out of it. But are there any questions that people have that we want to hit up? Interest rates are high, as well as property prices. Using data to buy means also competing so much. One
have to index the offer to win. So how to win? So basically saying that where you're competing with similar buyers in a markets, like let's just say Perth in WA, like everybody over there is sort of following the data, followed the data. And it's where to decide, well, how much you need to pay to win to buy the property. That's what Jay's saying. And even the same similar scenario, even places like Townsville at the moment, like investors are absolutely flocking up there. And you sort of say, the data looks fantastic, but what do you need to pay to win that property? That's kind of what he's asking, and what is too much? And it's a tough one. What are your thoughts on that, Jordan? Because you probably see it a little bit as well.
Yeah, I think it comes down to what you're comfortable paying with it. I mean, ultimately, it's a market, right? And you're competing against other people. So the property's worth what people are willing to pay for it. And if you really want to secure that asset, and it's a really great asset, you might be comfortable paying an extra 10, 20, 30 grand above market value to just secure it and get it across the line, so that you're no longer competing with 10, 20, 30 people at the next auction. Like you secure the asset, you get it down packed, and it might be 6 months or 12 months of value that you're paying in front, but ultimately the value of the property will increase past that point. You just don't want to get caught in a really heated market where you're the last one in, because if you're the last one in, then you are overpaying that 30 grand, and then everyone pulls out, and then the values of the property aren't increasing. So you just have to do that due diligence on what you think the property's worth, how many competitors are out there at the moment, put in a price that you're comfortable paying for that asset, and do the due diligence if it increases or if it doesn't. And then you secure that asset and you're not competing with everyone else in the market.
Yeah, and I think that's where I'm seeing a lot of people make silly mistakes where they're like, oh, cool, property has grown 20, 30, 40% over the past 2-3 years. I'm going to buy in markets that are not growth markets, but are cash flow markets, and expecting that capital growth to continue. And it's not going to. The people that live in those areas cannot afford to drastically increase the purchase prices from $300,000 to $800,000. So you're not going to be able to double, quadruple your money. They are not growth assets. Like, and a lot of this as well. Like, I know, like, I'm a buyer's agent and I buy property for people and I tell people how great I am. But a lot of it, like a lot of property growth has been inflation. Like there is a lot of inflation that has happened in the property market. So I don't think that we discount that. So just because a cash flow market has grown doesn't mean it will continue to grow. So you really need a balance. Like it's very tough buying at the moment. But if you do it right, you can still do some incredible things. But just don't. I don't know what the message to this is. I feel like this has been a bit depressing episode. It's just, I guess it's just reality, right? Like as an investor, there's risk associated to it, but there are some incredible returns.
It's also about being real. Like these are the things that not a lot of people have the conversations about. And so if you can understand everything holistically and see the opportunity cost and the things that are available to you, you can make an informed decision. So it is just about being real. And sometimes the story isn't all roses and daisies.
Yeah. This is an interesting one. Is it even Maggie asks, is it even possible to buy 5 properties in this environment? Absolutely. It is possible. I mean, are you going to buy them in the next 6 months? I think, yeah, it's a very kind of how long is a piece of string sort of question. Like if you strategically are sort of looking and speaking to your broker and sort of planning out, okay, purchase number 3 is going to be sort of 400-500K, and it's going to be likely with a second tier lender. And then purchase 5, it's probably going to have to be with a third tier lender. And I think this is probably what you talk a lot and see a lot about as well, Jordan. Like, what are your thoughts on this question? Is it possible?
Yeah, it's a great question. I would say most people get stuck at about 2 to 3 properties where they're kind of maxed out on their borrowing capacity. So to get to 4 and 5 is definitely a lot harder in today's economy with a limited borrowing capacity. The only thing I would say is don't focus on the number. Like for me, I would much rather have one $5 million property that is going to grow really well than 5 $1 million properties, or 5 500K properties versus one $2.5 million property. And that's just my personal preference based on looking at the data and growth rates moving forward. And so I think we've all got this fallacy of like, how many properties can I accumulate? And it really doesn't come down to the number. It comes down to you as an investor. And like the biggest advice that I wish I got when I first started is just buy the best possible asset that you can at this point in time, and don't focus too much on the number of properties itself.
No, I'm with you, mate. Mate, this has been an awesome session. Thank you very much. I feel like it's been a sporadic session where we're all property investors and we're talking about share investing and the pros and cons of that. So I feel like we should have got a share investor on to really hammer it home. But at least like do something. Like that's what I've got out of this session is if you're going to invest in shares, go ahead and do it, but just make sure that you continually keep adding to and making it happen. If you're going to invest in property, then get educated on what grows, what moves, and then work out a strategy that works for you, but base that strategy off the numbers. Jordan, I see you more and more on the Facebooks. You're getting more inspirational now. I see life advice coming. I don't know, the hair's longer. I'm digging it, man. How do people get more Jordan in their life?
Yeah, there's a lot of Jordan going around these days. So I'm pretty active on the socials, getting into the TikToks these days too. So if you're a TikTok fan, you can follow me there. But Facebook, I'm probably the most active. Instagram, TikTok, LinkedIn, all of the above. You can shoot me an email at jordan@gameplans.com.au. Love to chat all things property and on all the socials.
And thanks for coming on, Jordan. I mean, just sort of your wisdom and your knowledge and just your ability to map multiple sort of situations very quickly and sort of pivot is just outstanding. A lot of people would have been sort of fumbling around, and you were very quickly. It's impressive how you do it, and you've been sort of investing, I think, for probably at least 10 years now yourself. So you sort of have and spoken to heaps of investors. So it's fantastic to be able to lean on that sort of knowledge and be able to do that. So thanks for coming on and sharing an hour and a half of us and the Oz property community. I think people have actually loved it. It's been great.
No stress. Thanks for having me on. It's always a pleasure to hang out with you two on a Wednesday night, and love to come on again sometime.
Thanks, dude. Catch you guys. Let's go buy a property. See you later.
Hey guys.